Well, good morning and good afternoon to everyone joining us today. I'm watching those numbers climb, which is very exciting. We're just going to get started because we are a timely duo here. So my name is Carrie Scott. For those of you who don't know me, I work at Spruce Health. We are joined by Ryan Derousseau today, and he's going to be talking to us about how to transform your private practice income into future wealth. And even though I don't have a private practice, I'm eager to learn all about this as well. So our agenda today, we're going to do a quick, who is Ryan? Let's learn a little bit about him. What is Spruce for those of you who are new to us? Why do therapists work so hard but still feel so blocked at times? And that kind of segues nicely into the hamster wheel syndrome. We'll talk about how to transform income into wealth, investing tools, your greatest potential asset. And then, of course, we'll take questions. I did want to let everybody joining us today know that this is being recorded. So if for some reason you missed something or you've got to drop off early, you will have access to this recording after we wrap today. We also have disabled chat because it can get a little bit crazy, but please use the Q&A to drop in any questions that you have for Ryan, because we're going to be answering them. If they're relevant to the slide we're on, we'll answer as we go. And if not, we'll save them up for the end, but we will definitely get to as many of them as we can. So again, on the next slide, in case you forgot why we're here today, we're going to be talking about burnout in the mental health space and how finances play a pretty big role in that. As I mentioned, we're going to get into the common financial tools, why it's important to invest for the long term, and why all of you in particular often ignore a vital retirement planning tool. So I'm eager to hear all about that. And with that, let's meet Ryan. I'm going to let him intro himself because he knows himself best.
Yes, thank you. Thank you. I'm very excited to be here. I'm excited to speak to everyone. This is me and my non-bearded face. But I am a fee-only financial advisor, and I actually work most primarily with therapists, private and group practitioners, as well as the self-employed, enabling them to thrive financially so they can focus on clients. And the reason I got into this is because I used to be a writer, and I worked for myself for well over a decade as a writer. And when I decided to make the switch into financial planning, a group that I realized operated very similarly to me, they just had a lot more compliance issues, but a lot of the same self-employment questions that I had faced were therapists. And not only that, I really enjoyed talking to therapists. And not only that, they were really eager to hear some of the advice. And so that's why I do what I do today. About 90% of my clientele are actual private practice therapists. And so these are the types of conversations I'm having every single day now. And I love it.
I love that. Thank you. That's terrific. And a real quick, what's Spruce? I think the majority of you joining us today know what Spruce is, but in case you don't, we are a healthcare communication platform designed for all of you and for easy HIPAA compliance. Ultimately, Spruce consolidates all the communication channels. So from your business phone and your fax to your text and telemedicine, it's in one unified cloud-based solution. And I think the one thing that really sticks with me is when someone at the very beginning of my journey with Spruce said, yeah, it's like having my office in my pocket. And I thought that sums it up succinctly. So that is Spruce in a nutshell. But if you don't know more, please, I encourage you to visit the website afterward and dig in a little bit. But with that, I'm going to turn it over to Ryan and get into the meat of our conversation today. I'm going to turn off my video, but I will be keeping an eye on the Q&A. So ask away.
All right, fantastic. Thank you, Carrie. So before we begin, we just, finished tax day. It happened a couple days ago. I'd love to hear from you all, just sort of how tax day went, good or bad, up or down. How did it go as a private practice owner? I'd love to hear that. You can put it in the Q&A or wherever you can chat. So feel free and let me know how that goes, Carrie, when you see some responses.
Yeah, absolutely.
So I want to start off with sort of an issue that not only does like the numbers sort of support it, but also my experience in talking to many therapists sort of support it in that, therapists as a whole feel the symptoms of burnout. The APA found that 45% of therapists in 2022 said that they experienced some symptoms. It was a little less in 2021, but about the same. And I'm not sure about 2023, but my guess is it's very similar. And my also guess is that it could be even higher for those who are in private practice, not just because they are also the ones sitting in the seat talking to clients, but they're also running a business on the side. And with those two combinations, it creates an issue where it can lead to significant feelings of like never being able to stop work, always having to continue on that, what I call hamster wheel syndrome. And so, why does this happen? Why are therapists in particular so have that such a potential for that to happen? And part of it is just because of the style of work, right? If you are running a solo private practice, you are spending every hour that you are getting paid in front of someone. Unless you've developed like courses or something like that, then it requires your hours in order to get paid. And over time, like that first year, that might be totally fine. That second year, that might be totally fine. But at some point, that grind to constantly continue to grow and keep up with inflation and other things, it's going to be too much, and you're going to end up getting burnt out. And what I see often is it's either burnout or people just give up. They want a new career. I have people who've come to my office and asking if they should, become an Uber Eats driver on the side or something for extra income, just so they don't have to sit in front of a client. And we need to avoid that. So how do we avoid that? And it's the key part of creating sustained success in self-employment is being able to turn that self-employment income into wealth. So investing it in tools so it's growing long term. I like to call the retirement plan basically the secondary income stream for the business. It's not one that you're going to touch for years down the line. But as you see your wealth grow in that secondary income stream, you're going to feel a lot more confident in that business. You're going to be able to invest in that business. You're going to be able to invest in things that you want to do, whether it's travel or other things, because now you feel a little bit more secure in the business. So that's what we're going to talk a little bit about today. And so how do you transform income into wealth? There's a lot of stuff written about this stuff, like how to get rich or whatever. But in reality, there's only three ways to invest money to grow wealth. You either have to invest in the markets, you have to invest in a business or businesses, or you invest in real estate. And so today I'm going to talk a bit about the top one, invest in markets. And then I'll also talk a little bit about investing in business, since you all are in business. You may even consider you already investing in business, but I'm going to talk a little bit deeper and sort of talk a little bit about how that becomes a solo income stream or just an income stream to one that is an asset that can grow, that can be sold, that can be a retirement asset down the line. And so with that, let's talk about retirement. And when I'm talking to clients and whatnot about retirement, we are not starting with the X's and O's. We are starting more broadly. So in order to understand where you want to go, we need to understand what you want to do. And so, retirement is kind of a loaded word, because what do we think of when we think of retirement? We think, retiring and going and living by the beach, or and definitely not working. Maybe you're golfing, maybe you're doing something else. But for a lot of us, that has very little appeal. And so often people will refer to it as financial independence. But whatever that looks like for you, we need to understand that, and you need to understand that, so you know how much assets you need down the line to grow and build in order to cover whatever that life looks like for you. There's a lot of folks I talk to who want to, quit tomorrow, but there's a lot of others who feel like they can continue working until they're 80, 90 years old. And when I come across those folks, all I tell them is, that is awesome. I want you to be able to do that. I just don't want you to be forced to do that, because it's a big difference between being forced to work like that and actually just doing that just because you enjoy it so much. And that's really what we're trying to avoid. Another question we're going to ask is, what risk are you willing to take? When we're talking about investing, what we're really talking about is accessing risk in order for your money to grow to a size for when you need it down the line. We're not talking about like picking the right stock or whatnot. Instead, it's about that risk aspect. And so if you are more risk averse, what does that mean for you? If you are less risk averse, what does that mean for you in terms of total savings? So that's an important question to also ask. Third question to ask is, what risk do you have the capacity to take? Someone that comes in with a few dollars in savings and no investments whatsoever, they have far less capacity to risk because they just don't have the assets. Meanwhile, if someone comes in with $1 million, they're going to have a lot more capacity to take on some level of risk. And so we need to find what is the right capacity for you, and you need to kind of understand like where can you take risk and where you cannot. But all of that does not matter if you cannot sleep at night. And so any of my clients, when they're investing, when they're in saving for the long term, it's not about sort of, sitting in front of a screen and trying to evaluate this stock versus this stock, or is the market going to drop or whatever. Instead, we want them being able to sleep at night, because when we put together a plan, that plan is supposed to work over many years. It's not a get rich quick scheme. So if the market drops, it's okay. If the market rises, it's okay, because we're looking at the long term and we're figuring out sort of what that means for the long term. And if that long term is not looking good and you can't sleep at night, then we need to adjust either the risk you're willing to take or your capacity to take risk. And so that's one thing to think about, that I think a lot of people, when they get started, they're just like trying to put money in or whatnot. They're not thinking about that. And so I want to make sure that I say that. And then now we're going to talk a little bit about investing. I have to throw in some caveats. This is not personalized financial advice, so keep that in mind. I am just sharing knowledge right now. It doesn't mean that you should go out and do it. You should talk to someone and whatnot. I have to do that. But when we're evaluating investing, there's 3 different layers, and I actually liken this to the head or the brain. And so each layer is a different portion of protecting that brain. So the tools is sort of like your skull. This is the Sep IRA, the solo 401k, the IRA. It protects the investments and holds the investments. Then move down the sort of spiral and you get to the products. And this is essentially the brain. And so these are index funds, mutual funds, ETFs, exchange traded funds. That's what these tools are. They essentially hold the assets. And what are the assets? They're essentially the neurons. They're the ones connecting everything and determining whether you're gaining or losing by the end. These are the stocks, the bonds, cryptocurrency, real estate, whatever you sort of like evaluating. That's where that is. And I kind of liken that to the neurons in the brain. So I'll go through each one by one so you can understand sort of why it matters to kind of separate it that way. So let's first talk about the tools. Basically the tool determines how your investment is going to be taxed. So depending on sort of which tool you're using, which plan you're using, is going to determine when the IRS is going to take their money, because they're always going to take some money. And so when you are using a Roth IRA, you are saying, I am going to get taxed right now because I want to pay tax now and not worry about it later when I have a lot more money. And so that's why that sort of serves in that purpose. If you have a 401k, you're getting taxed, you're avoiding tax when you put the money in and instead deciding to pay it as income tax down the line. That's what determines that 401k design. What you need for your business is really going to depend on your own business's goal. I know folks who they are a solo practitioner, and they are going to be a solo practitioner until the day they die. They never want to manage anyone. They do not care about sort of growing the business as an asset. So they're probably going to be a solo 401k. Meanwhile, the Sep IRA it would be good for someone who wants to grow a practice, wants to hire a few therapists and provide benefits to them. There's big differences between the solo 401k and Sep IRA. Like, if you were just looking at the two and it just said how much can you just stock away in retirement accounts, theoretically the solo 401k and the Sep IRA are the exact same, because you can put, I think it's up to $69,000 into each one each year. But how that works is going to be very different. Solo 401k, you can actually add 30,000 as an employee, and then the extra 39,000 as a employer. And you can do that because you are both the employee and the employer of the business. The Sep IRA, you can add 25% of income, and anything you add has to come from the business. And so what happens is, if you have 3 or 4 people and you open a Sep IRA for yourself, and you give yourself 20% of your compensation as a Sep IRA contribution, well, then you have to give every single one of your employees that qualifies that same 20% of their own income as well. And so you kind of have to get locked in with the Sep IRA that you don't necessarily have as a solo 401k, but if you're growing, the Sep IRA or a traditional 401k is going to be much more likely something that you're going to have to think about. The taxable account, and so part of the reason I bring up the tools is because when we're talking about long-term planning, we want many different ways in which we are being taxed down the line to give us flexibility. If the more flexibility, the more we can determine, hey, we want to take less taxes now. Hey, we want to take more taxes now for whatever reason is going on. And to do that, we have many different tools at our disposal to manage our income in the future. So you have your 401ks, you have your IRAs, you have your Roth IRAs, as well as a taxable account. This is probably the account that people kind of forget about the most, because there's no tax advantage at the get-go. But later on in life, when you are, pulling money out of the taxable account, there's tax rates that are 0% for capital gains. So you could potentially be pulling money out of there at 0% rates. Or if you're younger and you're building into a taxable account, well, now there's no limits on accessing that taxable account. So say you want to buy a house and you don't have a Roth IRA, you only have a solo 401k. If you were to pull out a solo 401k, you may face a penalty. If you pull out of the taxable account, there's no penalty. So you want to make sure you're creating flexibility for yourself, not just in terms of how you're investing, but the tools that you're using to invest. And feel free to throw any questions there. I know that's a complicated kind of concept, but it's one that I think a lot of therapists get hung up on, which is that solo 401k versus the Sep IRA question in particular. And getting started is more important than not doing anything, but like understanding the differences is a key aspect to that. So now we'll get into the product. So I talk about the product not as sort of like, this is what I like to invest in, this is where you should be investing in. Instead, I want to kind of explain the differences here. And so what the product, you basically have 2 different styles when it comes to products. You have active investing, and this is where the investor like some investor somewhere is selecting the assets. So they're selecting the stocks, the bonds, other mutual funds. They may be trying to time the market a bit. And because of all that activity, they are creating higher fees because they have to afford their lifestyle. They have to afford all the investments that goes into properly investing in that way. But then there's also passive investing, which is like index investing, you may have heard. And these really just follow an economy, a sector, a country. So if you hear of like the S&P 500, well, that's a index fund following the 500 biggest companies in the US. Or you might see a total market fund. Well, that's investing in all the companies in the entire world, essentially. And so that is the difference between passive investing and active investing. Is they're not changing their opinion or stocks or bond exposure based on feeling of the market or anything like that. There's no human decisions. Instead, they're just trying to match the market within that. And because of that, there's a lot lower fees. And just from my 2 cents, what we find is that passive investing, because of that fee aspect of it, is far more advantageous long term. So the S&P 500 or the S&P Global did a study where they looked at active investing and passive investing over time. And what they found is that 90% of the active fund managers underperformed their passive benchmark within 10 years. And within 20 years, that drops down to 6%. So why are 6% outperforming? It's simply because in a bell curve, if 6% are vastly underperforming, 6% must be outperforming. Essentially, it's luck. And not only is it luck, but you would have had to have picked that active investor that 20 years earlier in order to get that right and get the benefits of that luck. And so that's why in my own practice, we're typically going the passive route for most things, but it's more about that fee structure, because the fees, you don't realize the long-term impact of those fees. I was reading a piece in Investopedia of all places, and they were outlining the different fees, and they found that if you had 80,000 that you were going to invest for 25 years with a 0.5% fee, by the end of that 25 years, you'd have $360,000. But instead, if you did the same amount, 80,000, 25 years, but the fee was 2% instead of 0.5%, you would have walked away with, I think it was about 220,000. So you basically be walking away with $140,000 less. And on a year-by-year basis, you may hardly notice the difference. But what happens is all those fees compound and compound and compound. They take away from your returns, and all those returns that are compounded with the lower fee structure are not in a higher fee structure. And in the end, you end up with considerably less money. And so whether you're going active investing or passive investing, the one thing I would highlight is make sure you understand the fees that are involved, because that's going to be a big aspect of your long-term returns. And now let's talk about the asset. So this is really what a lot of people think about when they think about investing, because they're thinking about stocks, bonds, cryptocurrency, whatever. And so this is really where getting the understanding of your risk tolerance and time horizon matter. For someone who's, like in the mid 30s, investing for 30 years, like whether the market moves up or down doesn't really matter over the next few years, because they're not going to need it for 30 years. Their time horizon makes it so they can take a lot of risk in their asset base. So they may have like a 90% equity exposure with only 10% in bonds, just because if the market moves down, it's actually better for them. Because what are they doing if the market moves down? They're buying into the market. They're gaining more exposure. They're buying the same assets they would be buying, except it's at a discount. And so now, because they've bought at a discount, they own more of that. And then when it improves, the market improves, they've now gained from that growth. And that is an incredible benefit over time. And so, when the 2008 financial crisis happened, some of you may remember that, Fidelity did a study, and they looked at by 2011, they were looking at what people did during the 2008 situation, and what they found was those that pulled out and just escaped, by 2011, they had bought back in, but only had a 2% gain. Those who kind of bought back in before the market hit the peak, again, had about a 25% gain. Those that just held steady, did nothing, by 2011, they had a 50% gain. And then those that kept buying, they had a 64% gain. And that's because of what I was just describing. They were buying assets that were much cheaper, and they were assets they were going to buy anyways. And so by the time that 2011 comes around, the market's returned, they're gaining from that. You also want to be looking at reinvesting dividends when you're looking for retirement. So companies will give off dividends. They're basically parts of the profit. And when you are in a Sep IRA or solo 401k or whatever, you can actually reinvest these dividends and not pay any taxes on them. And so that's what creates the long-term growth in like a passive investment portfolio and whatnot, because you're not pulling that out, you're not pulling those dividends out, you're not creating a tax situation or anything like that. And instead, it's kind of like free money that you're investing elsewhere. And you're often investing in companies that are performing poorly right now, but could perform better down the line. Um, if you're if you're investing in assets that are really kind of that passive design where they're just growing with the economy, well, then you're just capturing economic growth. And over time, that means that the investments that you're creating, as long as the U.S. economy grows or the global economy grows, then you're going to see growth as well. At the same time, you're creating tax advantages. You're not pulling in of your investments. You're not pulling out of the solo 401k and creating a 10% penalty or anything like that. And even in a taxable account, you're not having to pay for the growth as it's happening. And so that over time, that has like very big advantages for you. And that's why, investing some now can grow so large later. The other thing we're doing, we're diversifying. So we're not just saying like this one stock is going to do well. Instead, we're trying to cover our basis over many different assets and many different, names and whatnot. Right now people are sort of like down on bonds, and yet most people have exposure to bonds because there's a possibility that bonds do better the next 20 years versus stocks. It's not likely, but it could happen. And so we want to protect against that. But we're also looking internationally as well. And so the more diversified, the better off you'll be there. And then again, kind of how I started, we're pinpointing those goals. And those goals are going to help us determine how much risk we actually have to take in order to get where we want to go. So here's what we're not doing. And this is stuff that I think, people, when they're first getting started with investing, they think about. We're not picking stocks. Like, the people who are saying like, buy Tesla or buy some other hot stock, like we have exposure to that through our fund investment, but we're not saying we're not putting all our money into that in case it doesn't go. So if that stock rises, we gain, but we're protected if it drops. We're not investing in get rich quick scheme. This is a long time horizon. We are investing over many years. A lot of people are putting a lot of money into cryptocurrency right now. What does that mean? They're essentially stock picking because they're mostly picking Bitcoin, and they're hoping to get rich really quick. And maybe it'll work out, maybe it won't. I really don't know. But it's essentially like going to the roulette wheel and hoping it lands on your number. And when we're investing for retirement, that's not what we want. Instead, we want to create security for ourselves and whatnot. So we're not looking to just like, make $1 million overnight or anything like that. And we're not timing the market. So kind of what I was talking about with the Fidelity study, we're figuring out what our plan is. We're continuing to buy into that plan, expecting the market to perform well over many years and not trying to go up and down and pull out of the market, pull in when we see dips and whatnot, because what's going to happen is we're going to be wrong. And if we're wrong too many times, then our returns are really going to suffer for it. Any questions on the investing? Maybe, Carrie, are there any questions that kind of popped up there before I
Yeah.
get to it?
Yeah, thanks for asking, Ryan. We do have some questions. Let me just start at the top. So Colleen is asking at what age she can cash out her 401k without fines.
Yeah, at 59 and a half, you can start pulling the money out without penalty. There's other reasons you could potentially, but you'll have to like check those. You just have to be careful when removing, just because if you're under 59 and a half, it could create a 10% penalty. Plus, you're going to pay income tax on whatever you remove.
Okay, excellent. We have a question from an anonymous attendee. Where does someone go to get something like a Roth IRA or taxable account? Sorry if it's a silly question. I'm just getting started.
No, not at all. No silly questions. You would go to a brokerage account. So, when actually doing the investing for clients, we would be using what's called Schwab. A lot of my clients do not, I don't invest for a lot of my clients. Instead, they're choosing whichever brokerage is they prefer. So some like Vanguard, that's where I typically point people to. Other people like Betterment. That's kind of the newer name in the mix. And then what I always say is you just want a brokerage that offers low fee index funds. So essentially that you have plenty of options and you're not like getting stuck with like high fee funds and whatnot.
Okay, excellent. John is asking, can you start with a solo IRA and then start a SEP later? Or can you have a SEP for a group practice and retain a solo for your solo practice?
So because they're both practices, it's not likely that you're going to be able to hold a SEP and a solo, because essentially what the IRS would look at that as is, oh, you're trying to get out of the rules of a SEP by having the solo in the private practice. So my guess is that would not fly in that situation. You can go from a solo 401k to a SEP when you're ready to grow. I often start people in a solo 401k. Even if they think they're going to hire someone in a couple of years, I may still start them in a solo 401k if they have enough to invest. And so you can make that switch when you're ready. And it's like filing a form. It's not like a huge deal. You just basically have to shut down the solo 401k and then file a form for the Sep IRA.
Okay, excellent. Um, this is a question from Sarah. Ryan, do you happen to have any good resources on learning how to do ethical investing?
You mean like impact investing and stuff like that is what I'm like ESG investing and stuff like that. I not What I will do is I will send that to Carrie after, because I don't have it within like arm's reach type of thing. But I actually, when I was a journalist, I wrote a lot about this stuff. And so the one thing that you want to do when you're looking at ethical investing or impact investing is you want to make sure, because on the one hand, it's great, right? You're not investing in things like cigarettes companies if you don't want to invest in cigarette companies, or you want to invest in like companies that are good for the climate and whatnot. So on the one hand, that's really great. On the other hand, the more you do that, the more you're closer to saying like these specific companies are going to do well, and so that's called like picking the market. And so you want to avoid that. So you need to make sure that you're investing broad enough. But as long as you are, then it can be a really good strategy, because these are the companies that tend to not get in trouble by the authorities and suddenly have to pay millions and millions of fines overnight and whatnot. And so you actually see them perform better when the market performs worse, which is kind of nice. But I will send that along to Carrie after the webinar.
That's excellent. And there was actually another one along the same line from Greta saying, how does she find a financial advisor who will only invest in products that she considers ethical?
Um, that is going to take some searching, just because you're going to have to find the right financial advisor for you. Like for me, for instance, though, if I knew a client needed that going in, then we would work with them on that. But there are probably financial advisors out there that specifically focus on that for those who really want to invest in that way. The one thing I will say, when you do that search, and you can go to XYPN, that's a place to search for financial advisors, XYPN. Look for what's called fee only. That's why I had it in my title. And what that means is we are only paid by our clients. We're not paid by commission via insurance firms, via mutual funds to put you into certain things. And so like the business plan, it matches what your goals are to make sure you're getting the best advice. So that would be my only guidance there. But if you search like an XYPN or something like that, then you'll be able to find someone who really focuses on ethical investing.
That's awesome. Thanks, Ryan. Do you want to take a couple more or do you want to keep going?
Well, if there's a couple more strictly investing questions, but then yeah, let's do two more and then I'll move on.
Okay. So this is from Marcia. Any recommendations for someone who doesn't have anything invested and just wants to get started?
If you are looking for tax advantages right away, then it depends on your income, but look for, so if you have a pretty low income and you're not really worried about the tax impact of it right now, look for a Roth IRA, open a Roth IRA and start investing. If you're looking, and I'm talking generally, I'm not talking to your specific situation. If you are looking for some tax benefits now, then look for a solo 401k or maybe even an IRA. If depending on your income, you may be able to get some tax advantages there. So you just want to like match what your like desire is. But then like, one issue I would say that people just generally have when it comes to investing is they overanalyze, and their overanalyzation delays any sort of action. And in reality, the sooner that you get invested, the sooner you can get that like time going where things can compound and whatnot. And so it's better to get invested today more so than is this the perfect sort of like spot and whatnot.
That's great advice. And one last question. If you have a W-2 job and an independent practice formed as an LLC, are you eligible for a solo 401k?
If you have no employees, it's an awesome thing, because so when you have a 401k through your job, you contribute, and they then match a certain amount, right? But they're only matching like 3 or 4%. So maybe let's just say in a world where you're making a lot of money, I don't know your specific situation, but like let's say you're making a lot of money, you can actually put 30,500 in that, get the match there. And then on the solo 401k, you can just add as much as you want as the employer contribution, up to where the two are combined, adding 69,000 for the year. So you just can't go over that $69,000 number. I believe that's the number in 2024, but you can use the combination, since your employer on the W-2 side isn't likely to just throw you $20,000. But since you're in the LLC over here, you can actually do that for yourself. And so that's actually a really powerful planning method that we use for our higher net worth, not higher net worth clients, but the clients who've been operating for a number of years and have a good amount of money coming in.
Awesome. Thank you, Ryan. I'll let you get back to it, and then we can tackle any remaining at the end.
Absolutely. So the question I have at this point is, and you can put in Q&A or you can just think about it, is how much business lessons or business guidance did you get while you were getting your master's or your PhD in what you currently do? And I'm not going to wait for the Q&A, because I already know, I've talked to many of you. Many of you have said the same thing, that it was none. It was absolutely nothing. And it's on one hand, it's a shame because so many therapists operate in a private practice realm, which makes inherently them entrepreneurs or business owners. And on the other hand, it'd be nice if you had this lesson to learn from. But the fact that you didn't and you're learning on the go is totally fine. But we need to like understand our business and place it in sort of the overall financial picture because of that. And what happens a lot of times is when people have the therapy practice, they are looking to build, build, build. And by build means get enough clients, get enough clients, get enough clients. But over the course of years, you've basically created an income source for yourself. And then, someone like that will come into my office and we'll talk about, and then I'll put all their stuff in. And for the value of their business, the asset value of that business, I have to put at zero. And that's because it cannot pass on to anyone. It's not an asset that can live beyond the individual owner. And it's because you're maybe a solo practice and you don't have any therapists underneath you. And so as soon as you quit practicing, the thing disappears. And on one hand, like I understand it, I used to work for myself as a solo employee, and I get that sort of lifestyle. But on the other hand, this is your lifestyle. I mean, this is what you have built. You spent years building. And so the more that you can actually turn that asset into an asset that can be sold down the line, the better off you'll be. And I take every opportunity I have when I'm speaking to webinars, to podcasts, to whatever, to bring this up, because I don't think it's a talked about enough topic in the space. Essentially, what's happening right now is we are seeing a huge influx of baby boomers leaving the labor market. We're also seeing a huge influx of Gen Z entering the labor market. Meanwhile, you have a huge group millennials in the labor market. And so this creates a real opportunity for those with a business to then sell. And you're seeing that because of all the increase in interest in private equity, in tech companies in the therapy space. And why? It's because of these like global dynamics that are at play, and practice owners can take advantage of this. And the impact of that on long-term retirement could be huge. I once had someone come into me. He was in his like mid 60s, and he wanted me to evaluate his investment portfolio. So I took a look, and I would have suggested a few things and whatnot. But what I was most concerned with is that he wouldn't have enough money if he wanted to continue in the way that he was continuing. And I told him this, and I said, but one solution I have, since you want to work for the next 10 years, if over those next 10 years, you transition your practice into a small asset that can be sold for just $200,000, well, that takes you from maybe being okay, maybe not, to having like your dream retirement. And, he never became a client. It's not what he came for. It's not what he wanted to hear. But that was such an eye-opening experience for me because of what it would have required wasn't too much from what he was already doing. And so I would encourage anyone who's sort of looking at their entire financial picture, which includes the therapy practice, include that and see and determine if it's something that can be sold down the line. And one way that I love for practice owners to think about this is creating a system where you are actually mentoring your eventual buyer down the line. When you are, years from now stepping away, I am certain that there's going to be things that you would like to pass on to younger therapists. There's ways that you practice, there's ways that you treat clients, things of that nature. The more that you can ingrain that into a system, then you have something to sell. And so you can actually handpick your eventual successor and help them purchase the practice using the practice as the asset and the like cash flow generator. And so this is what's called an installment sale. And so what happens is it's not so much unlike buying a house. You have a therapy practice here, and this is the seller, this is the buyer. And so the buyer will put like 20% down and then pay installment payments over the course of 10 years. And the way that they are getting those installment payments is because of the profits from the business. And so the business is actually paying down the cost of the sell. And this has huge impact on your own retirement, because what's happening over those course of 10 years is you're not tapping your income or your retirement plan. You're not tapping your investments. Instead, what you're doing is you're living off the installment payments and then tapping a smaller portion of the investments, so those investments have more time to grow. Meanwhile, when you go through this process, you're not getting a big chunk up front. And so your taxes aren't going to just like skyrocket one year. Instead, you're easing out those profits over the course of time. And so therefore you're getting taxed at lower rates over the course of time. And so all of that combined creates such a security tool for your own practice, for your own retirement. That is something I always like to bring up in these, because I just think if more people think about this, it could create a lot more security in the retirement or in the therapy practice. I think that might be it. Let's see. Oh yeah, what do you need in place? And so, you can't just like wake up and sell the business. Instead, you need at least 2 years of profit. So it's not like, you suddenly get the thing profitable and you just sell it off. They want to see, a continuation of profits. They don't want to pay your credit card debt or anything like that. So make sure to keep the debt low if you're thinking about this. You need a client generator that's beyond you. If it's just your name and your credentials after your name in terms of like the practice name. You may want to think about switching the name because you want to be able to build this into something that can live beyond you. And then you need assets. Oftentimes that means therapists, that means like um, clients that are going to continue with those therapists long after you're gone. Maybe it's some sort of intellectual property or something like that, but you need something that can live beyond you in order to achieve this and successfully achieve it. But it's something worthwhile thinking about, especially, you know, when you're thinking 10 years, 15 years down the line. And you know, my goal was to have 15 minutes for questions, so I think I nailed that, Carrie.
You did nail it, like on the nose. That's
Yes.
fantastic. Let's get back into those questions, and folks, drop them in if you've been holding on to them. Okay, let's start here. Can you explain what type of 401k you should have when you have employees? If you have a SEP and put 35,000, does that mean you have to do the same for all employees?
Yeah, so a SEP means that you're going to take a percentage of your income, and that is going to be determined by the amount that you're paying yourself. And so it's not something where you can just say, I'm going to put $35,000 at the end of the year in a SEP and then do the same percentage to all my employees. Instead, you have to determine that with your accountant how much you can actually put into the SEP, and you can only put up to 25% in that. If you did give yourself 25%, then you have to give every single employee 25%. So at some point, the SEP becomes unusable for larger practices, and then they have to start thinking about like a traditional 401k and those tools. But that's for down the line. For a smaller practice with like 3 or 4, a Sep IRA can be a good way to give some benefits but not expose yourself to too much payment. And then you can also start using a taxable account to save on the side if you need to save more.
Okay, awesome. Pravina is asking, can you offer an example of an existing system or business that can be sold?
What do you mean in terms of like an example of this actually happening?
Yeah, I think that is what she means.
Yeah.
I can think of one from a gal that I spoke with recently, but I bet you have a bunch.
Well, I'm working with a client right now who they're a $3 million practice, and that's the goal by the end of the year is to sell it. They have a potential buyer that's talking to them, and it's something that they may do down the line. We're still in the process of it. And I don't think it has to be a 3 million. Like I said, that's a case where they found someone that wants to expand into a region. They want a practice that's pretty nice, you know, for that expansion. And so that may make sense for that. But there's situations where you could potentially, essentially, groom your successor and then do that. It happens in all sorts of other fields. It happens in my field. It happens in, law firms and dentistry and all these other things. And so there's no reason it can't also happen in the therapy space. I didn't tell this story, but I've told it before. When my wife used to see this therapist, and right before COVID, it's a really tragic story. She announced that she had pancreatic cancer, and she worked all the way up until like a few months after into COVID when she passed away. And, we didn't know if she worked because she had to or whatnot, but because we were near the family, we did see what happened after, and they had to sell their house and they had to move and whatnot because of the situation. And so that's like a tragic scenario, but it also, like, my wife took years to find the next therapist. Like if they had already started that process of potentially finding a successor and had begun that process of transitioning, it's possible that my wife would have just stuck with the new therapist, and then some of the financials that the family faced after would have been eased. It's a terrible situation no matter how you shape it, but at least the financials would have been eased.
Yeah, yikes. Here's another one. What are your thoughts on using a robo-advisor instead of a human financial advisor?
Yeah, so I would hesitate from like a holistic financial advising. I don't think they're there yet, but from an investment management standpoint, a lot of clients will use them. It's just kind of what you're comfortable with. Like Betterment, Robo Advisor, I've always heard pretty good things about. At least what you want is them getting you into low cost funds of some sort and making sure it's diversified. So if you're in like 3 or 4 Vanguard index funds through the Robo Advisor, you're probably pretty good, especially if you're just starting out. You're going to get charged a fee for that, and it's only going to be focused on investment management in that case. But as long as you're comfortable with that, then yeah, more power to it.
Okay, thanks for that. Anonymous person is asking, with fee-only advisors, do the fees that advisors take/charge vary? What is typical? Are there other questions you advise us to ask in finding the right match in an advisor, such that you may want to stay with them for the long haul?
Yeah. The fees definitely vary because there's a lot of different complexities. Someone who's just starting their financial journey is going to have far less complexity than someone with, trusts in their name and all these other stuff. So, you're going to have to talk to the individual advisor about the fees. You'll see ranges from 2,500 to well over 10,000. So it just depends on the complexity of your situation. In terms of the questions to ask, one is that fee only aspect, but then also it's just make sure they understand your situation and willing to speak to you about sort of how their process is. So much of the reason that fee only financial planners came into existence is because there was such poor lack of communication in other areas of finance. You go do your taxes, you just get your tax form back. You don't know why. You go to like a Fidelity to do your investment management. They tell you what to do from investing standpoint. You don't know why. And so that's really why the fee only sort of structure developed, is because not just the commissions, we wanted to be able to give advice and communicate. And so you need to, when you sit down with them, feel comfortable with the fact that whatever they're sort of describing, sharing with you, that they are going to be patient and you're going to walk away understanding why you're doing something versus you just hope that person is doing things correctly, because so much of the financial space operates that way. And then also just check what is called their Form ADV. They have to provide it before you go into an engagement, but that'll have like any sort of SEC complaints or bankruptcies or things like that. So you want to make sure that that's like all well and good before you start with them.
Excellent. Not sure if you want to speak to your fees right here and now, or if you'd rather have folks just connect with you afterward to talk about that. Do you have a preference?
Absolutely. I mean, yeah, range is like probably like 2,400 on the low end to typically about 6,000 on the high end. But on the next slide, I'll have my calendar. So if you're interested in talking to me about that, then we can connect. And I work with folks in 3 different ways. So we do one-time financial plans. We do subscription planning, where I'm meeting with folks every quarter throughout the year, so we can address some concern or some issue or the next thing in their financial plan. Or we do investment management as well. Yeah. And when we're doing investment management, you get the full financial planning experience.
Nice. Thanks, Ryan. A couple of folks have asked about investing in real estate. They're wondering if they missed that segment. Did we touch on that at all?
We didn't touch on that here because it's just too broad of a topic for this sort of setup. But commercial real estate in particular is a common thing that comes up in the therapy space. And, it's an awesome thing if you find the right investment. You just want to make sure that you are benefiting it in 4 different ways. One, cash flow. So if you have a portion of the rental to rent out to someone else. So you're creating some cash flow for yourself. You're appreciating, so the thing is getting gaining more value over time. Equity, you're decreasing the loan you have on the space with the cash flow that you're gaining through renting. And fourth, the big one, it's a big one, is depreciation. This is a paper loss on come tax time, but it can be very valuable to reduce taxes when you're in private practice. So definitely something worth considering down the line. It's not like the first thing to do, but for those who have interest and the willingness to invest in real estate, it can really pay off.
Okay, great. Chandra's asking, should I still do a solo 401k if I already have both a traditional and a Roth IRA?
So a solo 401k has higher limits, right? So between the Roth and the traditional, you can only put $6,500 a year in. I think that's still the case. It might have moved up in 2024, but for the like solo 401k, that limit is 30,000 as an individual, and then if you want to throw in employer contributions as well, 69,000. So it's a much higher number, and that 30,000 is with catch-up contribution. So if you're over 50, and so if your business is growing where you can put more than $6,500 in, then you really should consider that. And then the traditional IRA, your income just has to be below a certain level to get tax benefits today from it. Whereas, the solo 401k, you get tax benefits immediately, whether your income is, well above six figures or not.
Okay, and then Lynn is asking, what are the tax advantages of the solo 401k?
You're not taxed when you put money in. So let's say you put $10,000 in this year, come tax time, and you made $100,000, okay? And come tax time, you're going to start off with 90,000 as your potential tax exposure, because you're going to automatically reduce the amount that you're declaring to the IRS by 10,000. And then when you divest, so when you use it, that's when you pay income tax on that money. But all that growth, you're growing that money through those years, and you're never getting taxed on that growth.
Okay. Okay, great. Do you happen to have any resources for examples of diversified retirement portfolios?
That's really getting into the planning scenario, and kind of using that risk tolerance time horizon dynamic. But one place I'll point you to, there are resources out there. There's a tool or a group called the Bogleheads. They're just like fans of Vanguard founder, and they have a lot of resources about like what's a diversified model portfolio for those who are just researching online. That's a good place to start. There's also some books out there called like the three portfolio. I'll pass along the name of it to Carrie, but it's like the 3 portfolio retirement plan or something like that. And so that can at least get you started.
Okay, excellent. I think we have time for just maybe one or two more.
Okay.
So hopefully this is one you can answer quickly. What is the best way to set up that solo 401k? And when is a typical cutoff to convert to an S Corp for tax advantages?
The cutoff for the S Corp was March 15th. You can talk to your CPA and potentially get that in. Now they just have to kind of say you didn't know about it or something like that, and typically you can get away with it if that's something that would be worthwhile. Just be careful, because you can create a lot of headaches with the S Corp, just FYI. And then in terms of, what was the first part of that question? It was
Oh, the best way to set up the solo 401k, but then this person also clarified they're wondering about the income cutoff for the S Corp.
Yeah, so I typically want to see someone with a good amount of profits beyond 80,000. So they're paying themselves 80,000 and then a good amount of profits on top of that. It's a case by case basis, but you got to realize if you opt into an S Corp, you have to pay a lot more in filing fees, and you have to have payroll set up, and you have to have some other tools set up. And so if you're not going to benefit from it, it's okay. You can hesitate on opting in this year, but you just want those things set up first.
Okay, perfect. Let's get to your slide where folks can see how to contact you.
Absolutely. Let's see. Okay. So many ways to contact me. You can go to my LinkedIn. That's where I'm most active on social. You see my email there. And then I also have a free ebook that I published a couple weeks ago about this very topic, turning income into wealth, strategies for creating secure your private practice. If you go there, you throw your email in there, then I'll pass that along to you. And then if you are interested in talking to me directly, that is my calendar, the QR code. So feel free, you can click that and find a time that works for you, and I'd be happy to chat.
That's awesome. And just for everyone, I will share the slides. I'll share these important links that Ryan shared with us today, and I'll get the recording out as well. Look for that in your inbox later today. And we did it. It is exactly noon. Ryan, you did an incredible job sharing some very important information. I know I got a lot out of it, and I'm sure everyone else did, given the range of questions that came in. So thank you so much for joining us. That was a really incredible session.
Absolutely. Thanks for having me. I appreciate it.
All right. Thank you everyone for joining. Bye-bye.